Most of the strategies that I cover in other videos, you can use them on any time frame. It really doesn't matter if you want to do day trading and you're looking at an intraday chart, or if you're looking at a daily chart, a weekly chart. The patterns work all in the same way. It's the only thing that really changes is your time frame and how long you're going to be in the trade. However, there are some patterns that work much better on certain time frames. Today, we're going to go over the ultimate day trading strategy, and you'll see why I call it the ultimate once we get into the video. But it really is a very simple strategy, and it's almost too easy. It's almost like printing your own money. So if that sounds good, stick around and we'll see you after the intro. All right, so why do I call this the ultimate day trading strategy? Well, there's a few reasons. For starters, it's very easy to implement, and I'll show you that here in a minute. It's really easy to choose your entry points, really easy to get out, and you're making some really quick money. So that's the second point. It's very quick. Usually, you're only in this trade sometimes as quick as only 5 or 10 minutes. Sometimes you can just keep it for the rest of the day and see which way the stock trades. But typically, when you use this strategy, you're in profit within 5 or 10 minutes. So it really doesn't take up much of your day. And the third reason I call this the ultimate is you can make some really, really massive profits in those 5 or 10 minutes. So let's take a look at what this strategy is. Now, this isn't a strategy that you can necessarily trade every single day. You're just not going to get these types of setups. But when you do get them, you want to make sure you don't miss them. So what you need to do is either the night before or the morning of, prior to the market opening, you want to take a look at some charts, and there's a couple things you want to look for. First, you want to look for a stock that's in a pretty defined trend. So here we're looking at Nvidia, and you can see that it made this double top, or you can call it half of a head and shoulder pattern, back in say middle of July, and since then it's been in a pretty well defined downtrend. So you want to find a stock that it's not just trading sideways or consolidating; it's in a trend already, and it really doesn't matter if it's an uptrend or a downtrend. And what you want to do is you want to scan through your stocks, and you want to find one that has a huge gap pre-market. So that ideally is done the morning of, prior to the market opening. And it could be, it could be for any number of reasons. It could be an earnings report, it could be something that happened in the news, it could be a, political event, anything. It really doesn't matter what's causing the gap. But what you want to look for is a gap in the same direction as the trend. So let's look at Nvidia here. We got a perfect example. So like I said, it's in this well-defined downtrend below all the moving averages. The moving averages are stacked in reverse order, perfect downtrend. Then on this day right here, look what happened. So on August 2nd, Nvidia closed right around 107. So the next trading day, which was Monday the 5th, look at this gap down. So from the close on Friday to where it opened on Monday was a gap of around 14, let's say almost 15%. That is the type of stock you're looking for to execute this particular strategy. And Nvidia was trading like this pre-market, so this wasn't something that all of a sudden happened right as the market opened. For several hours pre-market, you could see that this was gapping down anywhere from 10 to 15%. So now let's look at how you trade this type of setup. What you need to do is you need to go into an intraday chart. Okay, so there's two main time frames that people use for this type of trade, either the 1 minute or the 2 minute chart. My preference is slightly to the 2 minute chart, only because you have a little more time to react. With the 1 minute, you really got to be a lot quicker on your trades. But either one will work. So let's look at both, and I'll show you what the differences were. All right, so this is what we want to look at. So this is the day that Nvidia gapped down the 15%, and we're looking at a 1 minute candle. So what we can see here is the first candle's red, so that's fine. And it had a little bit of a range to it. So it traded in the first minute from 91.20 up to about 93.08. So a pretty big range. And what you want to look for is you want to look for the first green candle. So that happened really quickly that day. Right on the second minute, we get this green candle, and this is a pretty nice, reversal type hammer green candle. So definitely a nice signal that we got right off the bat. Now, one thing you'll notice is this green candle, while it took out the body of the previous 1 minute candle, it didn't make a new high yet. So while this is a good candle to enter your long position, it's a little bit aggressive because we haven't taken out that initial rotational high yet. So what I did on this trade is I purchased some Nvidia on this green candle, and I set my stop right at the low of this candle, so just below 90.69. So let's say around 90.59. You want to give it a little bit of room. From there, you just watch it. The next candle was red, came back down, but never tested that low again. Now look at the fourth candle. So the fourth candle now took out the high of that initial rotation in the first minute. At this candle, and this is a very bullish candle, a very strong green candle up. On this candle, I added to my position. So what I did here is I actually moved up my stop on my initial trade. So I moved it up from 90.59 pretty much to break even, to around 92.55. And I added at the end of this candle. So basically somewhere right around here, I added to my position. From there, basically sit back and print money. So if we zoom out just a little bit, so this had a really nice run up, and your only question now really is, well, when do I sell? Well, again, there's a couple ways of doing that. Now, if we look at, well, let's just look at this first. So from our initial trade down here, so if we bought around 92.55 to the high, I mean, you made like 10% in a matter of, what is this, about half an hour. Yeah, this is 10 o'clock. So in a matter of 30 minutes, you made 10%. That's a really nice trade. Now, obviously, you probably didn't sell right at the high, so, maybe you only made around 7%, but that's still not bad for, a quick 15, 30-minute trade. Now, here's how I trade this. As long as you are above the VWAP, I like to stay bullish. So the VWAP is the volume weighted average price. And as long as the price is moving above there, even with these pullbacks, I like to stay long, at least partial position. So what I did, I don't remember exactly where I sold my first half. It probably was on this pullback here. I don't know. I can't tell you exactly what price I got out of, but basically what I did is I sold half my position. So the position that I added on this candle, I sold somewhere around here. And then what I did is I just moved up my stop on this initial position from 92.50. I now put it right around the VWAP. And I kept moving it up, or, actually, yes, this day the VWAP didn't move very much. It pretty much traded sideways. But I kept my stop on my initial position right below the VWAP in the event that the stock would decide to continue to run throughout the day, because that can happen also. Now, in this case, if we zoom out, I mean, you can pretty much see that, after this initial profit here, the stock pretty much just traded sideways for the rest of the day. It did dip below the VWAP, so you would have got stopped out here if you continue to hold it. I think I probably trimmed some more on this breakout here and kept just a small position, throughout the day to see which way the stock would move. But that's basically how you trade it. It's really, really simple. Just a couple more things about this strategy. Remember, what I said is you're looking for a stock that gaps in the direction of the trend. Because sometimes it can work if it gaps in the opposite direction, but it's a much lower probability. And this is a perfect example right here. So the next day, watch what happened to the stock. So remember, the trend is down, but the stock was quite extended. So this next morning, it actually gapped up, and it gapped up pretty strong. So from this close to the gap, about 5%, so not bad for a gap. But you can see the stock initially sold off, and at this point, you would think, okay, well, let's short the stock, because that's basically what this strategy tells you, is that if the stock gaps and then reverses, so in this case, it would be on the first red candle, that's when you would want to short the stock. Well, if you did that here, you would have got a little bit more of a downtrend, but after that, it quickly reversed. And again, once it came back up here, you would have thought, well, it probably looks like a double top as the stock started to pull back again, but then it would have broke out on you. So again, having your stop is really important, because if you did take that type of trade on this day here and put your stop up here, as long as you got in, say you got in on this red candle right here and put your stop right at that high, I mean, you're only risking less than 1%. So that's the other nice thing. I guess that's the fourth nice thing about this strategy. Because you're getting in at the low, at the gap on the first red candle or the first green candle, your risk is pretty low, usually around 1%. And your potential profit is usually in that 7, 10, sometimes even 15% range. Now, if you really want to take this to the next level, the other way to trade this is the exact same pattern with the chart, but instead of buying the stock, you buy call options. So on that example back here, when Nvidia gapped down, instead of buying the stock on this day, what you could have done is bought options, and then instead of making 7 or 10%, you would have made like 100 or even 200% real quick and within half an hour. So we saw, it didn't work on this next day, but let's go to the following day and you'll see what happens there. So look at this one. So now in this case, again, the trend is still down, and actually it was a pretty severe sell-off right towards the end of the previous day. And then we had a gap up. But now check this gap out. So this gap is right around 5% again, 4 to 5% in that range. But there's one key difference this time, and I'll go back to the daily chart here in a second and show you why. But what happened on this day here was the stock actually gapped up right into resistance. I believe it was the 8 EMA, but we'll take a look here in a second. So the stock gapped up right into resistance, and you can see it initially sold off, came back up, made a double top, and then sold off. And really it just kept selling for the rest of the day. So here we have it, here's the double top and just this huge sell off for the entire day. So if you did the strategy on here and sold short into this gap, so, after you have this gap on the first red candle, you either buy puts, you sell the stock short, and, just keep moving your stops. I mean, you would have had a really nice profit. If you got in, anywhere around here, and by the end of the day, again, you're up around 8%. So this is a really simple strategy. It's very effective. It has a very high probability of success. And like I said, when it doesn't work, your risk is very small, usually around 1%. So let's just go back to the daily chart real quick and I'll show you what I meant. So if we look into this area here, so this was the candle we were looking at, this was the initial trade on the gap down with the move up. This was the day where the gap trade didn't work. And then this was the day where it gapped up. And so you can see it's coming right into this resistance area. It's coming into the 8. It's also, we could draw a line here like this. This is a pretty strong resistance area. It was support, it broke through, it was support again, it was resistance, and then again resistance. So when you have, that type of structure to the left of it and a gap, watch those closely because those can give you some really nice gains, just like this day here did. All right, the last thing I want to show you is, like I said, you could do this with a 1 minute or a 2 minute chart. So let's take a look at the 2 minute chart. All right, so here we got the exact same day, the gap down in NVIDIA, the gap down of 14%. And if you're looking at a 2 minute chart, you can see it looks slightly differently. So it really depends on your trading style and how quick you are. Like I said, I prefer to use the 2 minute chart just because it gives me a little more time to evaluate the trade, evaluate my risk reward before I jump in. Now, the downside of it is if you were using this, you can see that the first green candle also took out the previous candle's high. Now, that's a good thing and a bad thing. It's a good thing because this is a much stronger signal than what we had on the initial 1 minute green candle. When you have a candle like this, not only does it look like a hammer, it's got a long wick, it's a green candle, it's a strong candle, and it took out the previous candle's high. That's a pretty strong bullish candle right there. Now, the only disadvantage is here you really only have one entry point. So at that point, you got to decide, do you go in bigger? Usually that's what I would do is I would go in, twice as big as what I would have as if I was trading the 1 minute chart and it hadn't broken the previous candle's high. Or if you go less, obviously, your profits are just going to be less. But I just prefer to trade the 2 minute chart. Like I said, it gives me a little more time to think about it. And, you might miss out on a little bit, a percent or two of profit, but I just find that it's a lot easier trade for me. But if you're quick, go with the 1 minute. It works just as well. All right, well, that's all I got on this strategy. Like I said, it's really simple. There's really not a lot to it. It works in both directions. It can work in an uptrending stock that gaps up. It works in a downtrending stock that gaps down. And it's really simple because there's nothing to think about. You don't have to try and guess which way the stock's going to go. It's a very mechanical trade, and that's what you want your trades to be. You want to be very mechanical. You want to have strict guidelines or strict rules on when you enter, when you exit. That way you're not, there's no emotion that's coming into the trade. There's no thought that's coming into the trade. You're just, very mechanical, very machine-like, and you know what your risk is. You know what your possible reward is. You just keep moving up your stops and riding that reward up and keep printing that money. So if you have any questions on this, please feel free, post those down in the comments. Or if you have any comments on this strategy or ways to improve it, other videos you'd like to see, anything you want to tell us, we'd love to see those down in the comments. And if you're enjoying this content, please hit those like and subscribe buttons. It really does help us out. And we'll see you next time.